Hello, good morning, and welcome to the portfolio update on the Amati Strategic Metals Fund. I'm Colin Thompson, one of the sales team at Amati, and updating you today are George Lequime and Mark Smith. We launched the fund 6 months ago to provide a means of investing in the producers of metals required for a low-carbon world and precious metals in one actively managed fund, a UK OIC structure. George and Mark will recap the investment approach for those of you not familiar with the fund and discuss how they've populated the portfolio with interesting opportunities since launch, giving some in-depth examples. Please submit your questions on the webinar page and we'll cover as many as we have time for in the question and answer session. With that, I'll hand over to George.
Thank you, Colin. Welcome everybody this morning. And for those not familiar with us, the Amati Strategic Metals Fund is managed jointly by myself, George Lequime, and my colleague, Mark Smith. I'm a mining engineer by qualification and spent 4 years working for Anglo American PLC on coal and gold operations before moving to Old Mutual Mining Team to manage the Old Mutual Gold Fund. I later spent 4 years in New York, heading up the North American leg of HSBC Global Mining Team before coming to London almost 20 years ago. After 5 years at Royal Bank of Canada, where I developed the London Research Department with Mark Smith, I went back to advising mining funds, this time European-based mining funds, with Mark Smith, where we've been for the past 13 years. Mark is a geologist by qualification and spent 5 years across East and West Africa on projects which were eventually taken out by majors. He returned to the UK to complete his master's in mineral project appraisal before coming across to Royal Bank of Canada, where we teamed up for the first time. And then later, after stints at GMP and Renaissance Capital, being lead analyst on mining stocks, he moved to advising the European-based mining stocks, mining funds with myself. And it's precisely this dual expertise, a technical background in mining and geology, as well as tens of years of experience in fund management and corporate banking, which when coupled with integration and the application of the Amati management systems, that we believe gives us an edge in investing in this sector that is notoriously tricky with regards to timing of one's investment in any one particular commodity. We certainly believe that metals will feature prominently in the background to the next decade. Apart from the natural growth in demand for metals associated with population growth, we are currently seeing an acceleration in the transition from fossil fuels to sustainable energy, a move away from combustible engines, and a greater emphasis on infrastructure spend, all very metals intensive. How supply for each metal keeps up with demand will determine the cycles or mini cycles for each metal. And these cycles will not be all aligned, as history has proved, and as we are seeing at the moment. For precious metals, rising debt levels, the end of the huge stimulus programs or tapering, rising bond yields, medium-term inflation expectations will all have an influence on gold and silver prices in the short to medium term. Looking at this simplistic chart of commodity prices relative to the Dow Jones Industrial Index going back to 1900, we can see these broad, long cycles where commodity prices can underperform for very long periods and then play catch-up over a 10 or 20-year period, sometimes quite sharply. What is more interesting for us is the long period of underperformance from 1990 to 2000, and then from 2010 to 2020. Linked to this underperformance is the industry's inability to attract capital to invest in exploration and development of new projects. This is what has partially led to the spikes that we're seeing in certain commodity prices, where supply is struggling to keep up with that surge in demand. Although metal prices should start settling down now as new production is brought on stream, there's no doubt that we'll see a greater focus on exploration and project build over the next 5 to 15 years, and prices could remain elevated for some time. As you can see, commodity prices have lifted themselves off the bottom. The first stage of any recovery in prices from an equity investment point of view is the outperformance of the pure beta plays. We saw this again this time around with the performance of the likes of BHP Billiton and Rio Tinto. The second stage is a little trickier with a greater emphasis on alpha, as well as differentiating between the metals. We think we're probably entering this stage of the broader cycle right now. We aim to actively manage the fund through regular and mini cycles. As you can see from the donut graphs at the bottom of the page, the weighting of the fund's investments between precious metals, industrial metals, and specialty metals will fluctuate with a maximum weighting of 70% in any one class at any time. Generally speaking, we envisage that about a quarter, 25% of the fund will be invested in precious metal companies with a balance in industrial and specialty companies over the medium to longer term. Ultimately, the structure of the fund is determined by fundamental value that we recognize right across the spectrum of mining companies that we thoroughly analyze. We take a very conservative view on metal prices and usually prefer to invest in those sectors that are ignored by the market in the short term. Usually this is where we find the best value and the best upside potential for share prices. Right now, we're positioned overweight in precious metals, as you'll see in later slides. But I'd like to just discuss a little bit the themes that are of interest to us right now across the three broad sectors. For precious metals, we're dividing the sectors into two, gold and silver. In brackets that you see in this graph is the exposure of the total fund to these themes. Firstly, gold. It's really been out of favor with investors since October last year, and particularly through the quiet, thinly traded summer months, where we saw some extraordinary reactions to share prices to any short-term mishaps or concerns. This has enabled us to invest in fantastic long-life companies trading at significant discounts to their historic multiples. Some companies are even discounting gold prices as low as $1,200 an ounce in their market valuations. Sometimes something that I haven't seen before in 27 years investing in this sector. Development companies have borne the brunt of the market's apathy towards gold stocks. And part of that is explained by capex blowouts that we've seen, rising inflation on some of the input parameters. And this is really, I believe, where we can use our experience and expertise to differentiate between the development companies and find some excellent investment opportunities. We also focus heavily on exploration upside, and we like to find companies with great exploration upside, not valued by the market. In this slide, we've given you a few investments that we've made on the gold sector. We are particularly excited by investments that we've made on the silver side, though, where opportunities presented themselves through overreaction to Latin American fiscal risk concerns and M&A transactions. Fortuna Silver, for example, which we'll discuss in more detail a little bit later on, acquired a high-quality gold producer with an exciting development project. The post-M&A sell-off means that investors investing at current levels get the development project and all the exploration upside for free. This is one of our sweet spots. For us, the precious metals sector right now is presenting some great medium and long-term investment opportunities. On the base metals and specialty side, we invested in the nickel and lithium sectors rather than copper on the onset of the fund, purely on fundamentals after the sharp run that we saw in the copper price. We've also preferred class 1 nickel used for EV battery cathodes, and especially green nickel with its low carbon footprint, as opposed to pig iron nickel, which is used in the stainless steel market. Again, as mentioned earlier, we like investments where we're getting value for free. This time, base metals in Adriatic in the current share price. Finding investments in the critical specialty side of the market can be difficult and time consuming, but we found some very good companies where we can get exposure to the anode and cathode side of the batteries, as well as non-Chinese rare earths. Now, I'm going to hand over to Mark at this juncture to take you through the current composition of the fund in more detail. Over to you, Mark.
Thank you, George. We launched the Strategic Metals Fund during a very volatile period in the market. This was driven by a remarkable Chinese economic recovery post the first COVID phase, which largely spared the commodity market from complete disaster. This was then tempered by the Federal Exchange's fiscal tapering talk, and then the Chinese trying to ease the inflationary pressures they created through credit control, taxes, and direct market intervention. So when we look at the market over this 6-month period, and we use the base metals sector, illustrated by the 33 metal stocks in the S&P TSX index, you can see that rallied up 15%, only to negatively correct down to zero over the forecast period. And similarly, when we look at the gold side of things, the VanEck Junior Gold Index, which is composed of 94 small and mid-cap stocks, that fared even worse, with the peak to trough performance positive 15 down to negative 15. And what I want to stress here is that our actively managed fund performed in line, if not slightly better, than the base metal indices presented here, whilst the fund still retained 56% precious metal optionality for investors. So we largely outperformed the precious metals index and retained optionality for investors with our gold and silver investments. And we achieved this by retaining quite a high cash weighting from the outset of the launch of the fund and continue through to today around 9%. And also we focused on investing in value of growth stocks, which weren't reliant on the underlying commodity price for performance. If we look at the split of the fund, the portfolio highlights here, the Strategic Metal Fund is designed to be an evergreen fund through active management and diversification. When we look at the asset class split, we've got a diversified portfolio with investments across precious metals, specialty metals, and base metals. And the specialty encompasses lithium, graphite, rare earths, cobalt, vanadium. On the base metals, it's lead, zinc, nickel, copper. You can see that the asset class is biased towards precious metals. We have about 56% of the fund in this class, and that's given the potential returns that we see from this sector. And George will highlight more on this later in the latter part of our presentation. The cash remains quite constant at 9%, and we continue to selectively deploy this against active inflows that we're seeing at the moment into the fund. This will reduce volatility, and the cash component has come down from 32% to 9%. And we kept a high cash weighting initially to really reduce volatility once we launched this fund. When we look at the geographical exposure, it's important to stress that we're a global fund, UK listed with global access. We've got a global diversification with our investments across all continents, but its particular focus is North and Latin America, with about 50% of the portfolio exposed to this region. This is quite an important area for us to manage risk. So the geopolitical risk in mining, it can be quite considerable at times. So by deploying our investments across all geographies, we're able to manage this risk quite successfully. When we look at the size of the companies that we invest in, the market capitalization breakdown, our sweet spot for value growth is between $250 and $500 million in size. And these are the companies that have an ability to grow to the multi-billion-dollar size, but also their M&A targets for what we think will come as a next wave in our industry. Also, these small to mid-cap companies, we can deploy our geology and mining expertise as well as our financial to really understand these business models and look for the value drivers going forward. When we look at the portfolio and the top 10 holdings, 34% of our portfolio here is contained in the top 10 holdings, with precious metals representing about 21% and the specialty and base metals around 13%. We've got an actively managed fund here, so we have an ability to change the top 10 according to value. But you'll see that there are some large cap stocks in this top 10, and that's largely a function of the market's apathy for these precious metals. So we've invested in these large caps, which reduces short-term risk in the fund whilst retaining the upside in stock re-rating. What's important here as well is that we limit the percentage holdings of each stock in the portfolio to manage risk, be it geopolitical, commodity, development, or single asset risk. The next two slides, we're just going to address some of the winners and losers we've had in the portfolio. And from the positive contributors, our thesis from the outset has been to identify businesses with an integrated business model from mine to market, and try and look for investments that meet the market's demand for low carbon supply of tech metals. We've identified quite a few investments in the lithium and nickel space we've highlighted here, but also now starting to see opportunities in the graphite market. But the investments in lithium and nickel have given us returns so far between 25 and 74%, and have made a positive contribution to the overall portfolio return. What's interesting here with both the lithium and the nickel businesses that we've highlighted is there's a theme of modularization of assets, and the market's really taken this on board, that these new green tech metals, the future supply and demand is a little uncertain, and these companies have an ability to expand their businesses as and when market conditions dictate, and the market's really rewarded companies for this. I'll then hand over to George to really address the negatives, and what's probably important here to stress is that we understand the negative short-term events that have driven the precious metal stocks down, and given our technical understanding of mining, we're quite comfortable with the short-term underperformance in these stocks. But I'll hand over to George.
Thanks, Mark. I think anybody who's invested in the precious metals, gold and silver shares over the past while, know that they've been out of favor for a while now, and there's quite a lot of apathy in the market. Interesting, all 5 of the companies on this list were hit by short-term events, which resulted in extraordinary pullback in share prices in a weak market. This has been really a dominant theme in the precious metals equity markets over the past few months, where we've seen short-term focused algorithm funds having a huge bearing on equity prices. And it's resulted in a lot of volatility in the sector. Now, algorithm funds can be a help in a rising market, but it's also detrimental in a weak market. So what it does, it gives us great opportunities for the fund to invest in very, very good companies with a medium to longer term outlook. The fund size at the end of August was around 36 million sterling. Right now it's just over 40 million. The number of holdings, 39, is really where we'd like to be. 35 to 45 is our target in order to maintain our level of due diligence that we need to do on each company. You can see that the median and average market cap of the investments in the fund is just over 1.2 billion, 1.7 billion and 2.1 billion, respectively. And then we have a wide range in our investments, from about $50 million to $8.6 million. I'll hand back over to Mark at this stage just to run you through a little bit more in detail how we approach our investment opportunities in the sector. And it's going to be highlighting 3 particular investments. Over to you, Mark.
Thank you, George. So we've started to include these investment spotlights in our presentations, really as a way to highlight our approach of applying our dual expertise to judge an investment and walk you, the investor, through how we're thinking and treating investments in our portfolio. We've chosen Fortuna Silver. This is the largest holding in our portfolio, and it was caught in an event-driven sell down. This Latin American silver producer acquired a West African gold producer, as George highlighted at the beginning of the presentation. And this merger, although it improved the financial position of the company, the market has sold the stock down against the market. And you can see Fortuna's underperformed around 45% against the GDX, which is down 8%, and its peer group down 14%. This event-driven sell down really piqued our interest, so we did a lot more work on this company. And you can see the ratio analysis, be it PE, EV to EBITDA, or price to free cash flow. The peer group and the market generally rallied over this period from April to the end of August, yet the Fortuna derated. So really just to give you a comfort that this is a solid business, Fortuna Silver is a solid cash flowing business with mines producing silver and gold across 3 countries in Latin America. The market's concern was also about the short life of mine, particularly at San Jose in Mexico and Caloma mine in Peru, around 3 years. But given our backgrounds in mining and geology, as we stated, we're rather comfortable with this resource, and we expect resource growth through exploration over the coming years. These deposits are low sulfidation vein deposits, and they never occur in isolation. And generally what you see is a reserve base delineated about 3 years, rolling forward for 3 years at a time. So we expect these 2 mines to continue and produce free cash flow. The recently launched commissioned Lindero mine in Argentina. It's quite exciting for us. It's got a 12-year life, and it's a gold porphyry deposit circled in gold, the Lindero deposit. But if you look, there's the Arizaro geological footprint not too far away, which has similarly got similar geological characteristics to this mine. So we expect further discovery from the drill bit going forward. If we look at the actual assets that Fortuna acquired from Roxgold, during this sell down event, the market has largely priced out on our in-house analysis and calculations about $750 million of assets from the current share price. And the Yaramoko mine in Burkina Faso was one of the world's largest, highest grade underground gold deposits, producing around 100,000 ounces for the next 7 odd years, excluding exploration upside. Also, they've got a very exciting orogenic gold deposit in Côte d'Ivoire, which has got a million ounces, but we expect this to grow over time. And geologically speaking, you can see we tried to highlight here that the reserve is delineated by an in-pit pit shell of about 1 million ounces, but you can see that ore body continues down dip, and there's evidence now at Seguela that they're tapping into a parallel system. So we expect additional resource growth from this company going forward, hence why this is one of our largest positions, if not largest position in the fund currently. When we turn our attention to lithium, Sigma Lithium is one of our preferred holdings in the battery metal space. And when we started to look at this area, we wanted to look at businesses with a vertically integrated investment model. And that means from mine to market. We talked a lot about this in our newsletters. So this company will produce a coarse spodumene, which is a hard rock lithium source. And through processing, they can upgrade that from 1.5% of contained lithium to 6%. Through their joint venture with a chemical toller, they can produce chemical grade lithium. And what I want to stress here is that although the fundamentals for the spodumene hard rock lithium price has done very well, increasing from about $400 a ton to close to $1,000 a ton, there's good margin in this business alone. Where we see the real value uplift is when you look at the lithium chemicals which are used for the batteries. That's lithium hydroxide and lithium carbonate. And those prices are ranging at the moment around $15,000 a ton. And there are projections that this could comfortably go beyond $20,000 as a long-term sustainable price. So what you need is a company that has a deposit which is strategic enough to support, entertain a chemical toller to get into the business with them, and also large enough that they can expand. And this investment has a sizable deposit with offtake and a joint venture with a chemical partner, which is very important. So this company can really participate in the high return on invested capital of the producing chemicals for the battery market. When you see the company, it's got a scalable mine, as I pointed out at the beginning of the presentation. And this company can double its production quite easily to adapt to market conditions as demand predictably will increase for lithium. It's got one of the highest grade deposits at 1.55% lithium. And also importantly, it's one of the lowest cost, potentially lowest cost producers according to its definitive feasibility study at $350 odd a ton against a revenue of $1,000 a ton currently. So this also allows it to be one of the lowest capital intensity projects in the lithium space. And that's a function also that it's got access to cheap renewable power in Brazil. Finally, when we look at another sector, it's the nickel market. And you can see that the price of nickel has run quite well over the last 6 months, but it's got a long way to go. And really, the nickel market, as George highlighted earlier, 70% of that currently is for stainless steel demand. So the delta on the supply and demand of this market will be the electric vehicles going forward. So you want to be in the metal that the auto manufacturers actually want, which is the high-grade nickel sulfide projects with a low carbon footprint. That's the mandate the OEMs have been given by shareholders and the market in general. And this fund, the Strategic Metals Fund, is trying to invest in the greatest hits of mining stocks. And Centaurus, in our view, is one of these. It's got a high-grade nickel sulfide deposit with the ability to expand through exploration. And they've only really drill tested 50% of their tenement area. So the Onca deposit currently can support a 13-year life of mine. But these nickel deposits are magmatic intrusive related, and they're controlled by deep-seated geological structures. And as you can see here on the right-hand side, the greenfield growth potential, a lot of these structures continue from the existing ore body out into untested areas. So we expect a lot more value and growth to the resource to come through the drill bit going forward. Why we like the company? The current stated project is about $1.6 billion in value. The market cap of this company is just over 350 Australian dollars million. It's got a 13-year life of mine. But because of the high-grade nature of this deposit, access to renewable power and close to port, its carbon footprint is one of the lowest in the world globally, and less than 97% of global nickel production in terms of its carbon footprint. So this will be a target for OEMs and car manufacturers going forward. Now I'll hand back to George to really discuss the strategic case for our precious metals holding in the fund.
Thanks, Mark. We often get asked about the inclusion of precious metals in the Strategic Metals Fund. Well, apart from having natural negatively correlated defensive qualities, gold and silver also act as a very good diversifier in a portfolio in the medium to longer term. While sentiment may be at its lowest level in 11 years at the moment, it ignores the fact that precious metal prices, especially gold, have on average returned 9% per year for the past 20 years, 7.5% over the past 5 years, and even 3% over the past 10 years. Industrial commodity prices tend to be more volatile and are not always positive year on year. Now, with gold prices down already 8% over the past 12 months and commodity index up 54% over the same time period, it's difficult to get just too negative on the outlook for gold over the next 12 to 24 months, given its consistent returns over time. Now, since inflation is currently so topical, we included a slide in the bottom right-hand corner here from the World Gold Council website, which shows the performance of gold and industrial commodities during times of high inflation, which is more than 5%, moderate inflation, 2 to 5% inflation, and low inflation environment, which is less than 2%. As you can see, you really want a decent exposure to gold in times of high inflation, as well as low inflation. Actually, history suggests that we could see a sharp correction in industrial commodity prices should inflation fall sharply. In times of moderate inflation, it's really much of a muchness. Very much in the way that we see copper and aluminium prices probably run too far ahead of their fundamentals, the chart on the left suggests that gold has been consistently sold off relative to real interest rates, here reflected by the 10-year tips, since the vaccine breakthroughs in October last year, and the market really taking a more risk-on approach to investing. So the way we see it is that the market's constantly anticipating higher interest rates coming through and inflation coming back as well. Now, we've had periods since October where we've seen this gap closing again, but right now the gap is quite wide, suggesting that the market's already discounting quite a bit of rising rates and falling inflation in the current gold price. Now, we really remain agnostic towards gold, but we're not prepared to take a very bearish stance on the outlook for gold over the coming years, as most commentators out there are. And virtually every broker that you read the research reports have gold coming down 10-15% over the next 2 years. Because if you look at the trend relative to fiat currencies, it's really been consistently falling. The fiat currencies have been consistently falling over the past 21 years, with no real suggestion that this trend will change. And you can see that on the chart on the right-hand side. Now, with the market's negative views on gold comes apathy, obviously towards gold mining shares, where the fundamentals actually keep improving. Balance sheets are solid, dividends are being raised, and exploration success is actually improving intrinsic value in a number of businesses out there. Right now, according to Scotiabank, and our models confirm this, the sector as a whole is already discounting a gold price of around $1,400 an ounce, or 21% below spot. Within this, we find a number of companies actually discounting well below $1,200 an ounce. On the right-hand side, this is the EV to EBITDA of the sector going back to the 1980s, where the sector used to trade at 20 times in a bear market and up to 40 times in a bull market. And that rating really collapsed after 2009, 2010. It's never really recovered despite the complete overhaul of company strategy, with a number of companies showing real growth in value through the drill bit, through some M&A activity. And the average now for the sector is around 5 times EV to EBITDA. In the fund, we have some great quality names with EV to EBITDA multiples between 2 and 3.5 times. With life of mines of 20 plus years, this is way more than most of the senior gold producers out there. So in summary, when you're looking at the entire sector, we think we're going to continue to see volatility over the coming months, with a recovery in the beaten down gold and silver equities probably driving this fund higher. The pullback in fiscal stimulus policies should calm metal prices that are most sensitive to global economic activities such as copper and aluminium, where we'd see some price consolidation to take place over the coming months. Although we should see metal prices remaining well above their longer-term incentive prices in the short term, given the muted supply-side response that we've seen to date. The take-up of EVs and the rollout of renewable energy initiatives continues to surprise on the upside, with positive adjustments being made to demand estimates in the short to medium term. The reluctance to restart closed operations and aggressively develop new projects has fueled lithium prices in particular this year, after the slump in prices that we saw in 2018 through to 2020. The big question for us is the degree and the speed at which this new supply will be brought to market over the coming months. And the market always looking forward whether this really puts a lid on prices in the short term. Now, we've mentioned many times that precious metals companies are very much out of favor. and it remains the sector that we find the most compelling value and exciting investment opportunities, to be frank. However, we are constantly looking across all sectors at all times, and actually increased our investment in an interesting lithium company as well as a graphite company over the past few days. Now, with that, I would like to thank you for your attention, and I'm going to hand over to Colin to conduct the Q&A session.
Thanks, George. There's been a few questions submitted by the audience, and I'll take them in the order that they came in. The first one was, what IRR do you target for your fund given the current market conditions? Who would like to take that?
Yeah, I'll take it. I mean, what we do is every investment that we make, we have a targeted return over a 12 months period. At the moment, the indicative, assuming a constant state over the next 12 months, is around 89–90%. And what we do is with all the investments that we look at, we compare that to the indicative returns of the companies that we have in the portfolio. So it's really one out, one in for that kind of return. But in general, Colin, and again, I've just put a little asterisk on it, that it's these are volatile commodity prices, but certainly they are the returns look very, very attractive right now. Okay,
there was a question on inflation relating to the impact on the gold price, and you possibly answered that in the slide where you covered that. But I'll ask it anyway if you want to reiterate. If inflation proves to be non-transitory, will that have any near-term impact on the gold price?
Well, we're seeing a lot of debate about this, and we've also seen some funds using commodity prices, industrial commodity prices, as an inflation hedge, and other instruments that they use to hedge against inflation. History has proven that usually gold prices perform really well, silver prices especially. So if you are of the belief that inflation will be higher for longer, we should see quite a sharp recovery in silver prices. Which, remember, silver prices are half the level that they were in 2011. So it's the one commodity that hasn't really moved significantly over the past 12 months.
Excellent, thank you. The next one that came through was, what are the locations of the non-Chinese rare earth materials? Who would like to take that one?
Yeah, I'll take that, Colin. So geologically speaking, rare earths occur in ionic clays, which is an intensely weathered horizon, or near carbonatite volcanoes, which is weathered and leached to produce rare earths. And these are found across the globe, but particularly in Tanzania, we found one company that is actively exploring around a carbonatite volcano to produce the light and medium rare earth deposits. Also, in our holding of Hochschild, as George mentioned, we've got exposure to actually one of the only ionic clay sourced rare earth projects, heavy rare earths, which are needed for the fixed batteries, for thermal stability, outside of China in Latin America. So we're quite excited about that, and you're largely getting that asset for free in the share price of Hochschild. But that's what part of the challenge is the Chinese market controls close to 90% of current rare earth supply, if not all of the heavy rare earths. And what we need to try and do is find deposits outside of that. And interestingly as well, some of the heavy mineral sand companies like Lequime in Australia, if you can get a deposit which is high in zircon and ilmenite, they actually get a low concentration of rare earths with those products. And they're looking at trying to increase recovery in these deposits to try and make a rare earth concentrate. So that there are not as many opportunities outside of China. I think that will come as the market develops going forward.
Okay, thanks very much, Mark. The next question says, on slide 8, was there any indication of your fund performance? I understood it to be showing only the junior gold miners index and the base metals index. Now, I can sort of take part of that in that we believe that the FCA rules sort of don't permit us to show performance within the first 12 months on a financial promotion. However, George, would you like to talk a bit about the performance?
Yeah, I think Colin, Mark mentioned that our performance has really been in line with the industrial metals sector over this time period, despite our high weighting in gold, which is quite encouraging for us. So, but as you say, we couldn't include it.
Okay. Great stuff, thank you. The next one, is there a bias against uranium?
Uranium?
Yes.
No, there's no bias against uranium. Obviously, we're seeing uranium making headlines in the newspapers right now. It's a financially driven rally in uranium prices, and I think it's pure speculative. This fund is not about speculation. We've covered and we've followed uranium for many years. When you have a fund that attracts capital to buy uranium in a very thin spot market to make the price go up in the short term, in anticipation that there will be a tightness in the market in years 4, 5, 6. How do you get your head around what's going to happen in the short to medium term? So there's so many variable factors, but it's similar to what happened with the Reddit crowd with the silver market a few months back, where there was an attempted squeeze on the silver market, and we saw silver prices rolling close to $30 an ounce and then pulling back. So it's one, Colin, it's an interesting development right now, but these companies, they sell their metal on term basis, not spot market. And the question is whether the utilities are going to be prepared to enter into new contracts at a higher term price, and that's what we're speculating at the moment.
I would add, George, it's a bit of a game of bluff here, because this scenario only works if the financial demand for uranium through physical spot purchase continues to force the utilities into the medium-term market on contracts. And if they hang back and there's talk of them having 2, 3, 4 years of inventory still on their books, I wouldn't want to take that bet on the utilities being forced back into the market anytime soon. So you've got to continue to financially buy the uranium market into a supply deficit through demand engineering, and it's not a sector that we want to invest in comfortably at this stage.
Okay, thank you. The next two questions are about China, so maybe we could couple those. Do you think markets are focusing too heavily on Chinese demand for industrial metals, particularly copper, given the US and EU's green spending plans? And is this fund going to be very correlated to Chinese economic growth?
I'd say on the demand side, the problem we faced when the copper price rallied from 220 at the beginning of COVID up to closer to 5 is there was a potential supply shortage in global inventories being moved around the world. So you got the Chinese buying ahead to increase inventory. What's happened then is you've created such an inflationary environment in China that they then had to deploy some of their strategic copper reserves, and there's numbers floated around about 2 million tons of copper they're sitting on in a 30 million ton global market. So it's enough to quell the demand. What we're seeing and the view we're taking is generally that there's a seasonality to Chinese demand, and what we're seeing is the inventory adjustments and actively selling of inventory into Q4, which is generally a theme that happens in China. And again, that's going to be a way of them reducing the inflationary impact of high commodity prices. So we see that the Chinese market is going to cool off slightly, and news today that there's potentially credit default in one of the banks that supply financing for home construction starts. That's going to have to be unwound, and that could have an impact. Most of the demand in China is for home start construction, and that could provide a lot of weakness in the Chinese market in the short term.
Yeah, I'd add, Colin, that 96% of demand for copper right now is still from traditional markets, construction, consumer goods, and China is 60% of that. So the decarbonization demand for copper, for example, is 3 to 4%. So it's in a tight market, it makes a big difference, and it's scheduled to increase up to, I've seen figures up to 10, 11% in 2035. So and it will replace any slowdown that we may get from the traditional markets for copper. So I think it's the other way around. I think the market has maybe got a little bit too ahead of itself with the demand on the EV side, which is still pretty small. And with the slowdown that we're seeing in China that Mark's mentioning, even with the pickup that we'll see in the US, that's what you really need to focus on in the short to medium term on the copper market.
The next question was, are these slides available as a pack? And yes, they are, if you'd like to contact us here. And at this point, I could mention that we've also published an investor guide for the fund with some interesting statistics on the extent of the opportunity over the coming years. So if you'd like to see that, please get in touch. And we've put the investor guide on the homepage on our website. The next question you may or may not want to get drawn on, but I'll ask it. Are you in the fund targeting at least a 2 times return over the next 5 years?
Well, yeah, absolutely. I'd say we've got to be careful with the compliance, but as George highlighted, from our financial modelling on a 12-month view, our indicative return, if the markets behave themselves for the fund, is over 80%, and we expect that to continue on a 24 and a 36-month view. And a lot of these companies that we invest in, as I said, we're a small mid-cap focused fund. As these companies get closer to development decisions and production, the value of their businesses grows. And so we should see even more investment return on some of the stocks that we've invested in for the developers and explorers.
Hey, I'd add, Colin, is that I mentioned early on that we're entering that second phase where a greater focus on alpha driving the value of these companies. We've got a lot more capital being attracted from a dearth of capital that went into the sector in the past 10 years. So we're seeing that money going into exploration, where maybe the market is not paying for growth right now, but we're seeing some very interesting companies with huge potential to grow the value of their business. So, we don't want to get suckered into whether it's a 2 to 5 times return. But what's very, very exciting is that these companies have now got the capital to grow their businesses, and as Mark said, it's that sweet spot of the small to medium cap companies that will come through.
That's fantastic. Thank you very much, both George and Mark, and thank you, the audience, for your questions. And if any other queries come to mind, please get in touch with one of our sales team here. I think there's maybe more questions coming through, but we'll take them offline. Once again, thanks very much for your interest in the fund, and Until the next time, goodbye for now. Bye.